Good afternoon and welcome to the Wall Street Crossover Show, sponsored by Admiral Markets and with their market commentator Darren Sinden. Good afternoon, Darren.
Afternoon, Zach.
Right, a bit of excitement in the financial markets, courtesy of the Chinese. Still reverberations?
Yeah, it wasn't a one-off, is what we've learned, and remains to be seen if they're going to do any more. But it's certainly set the cat among the pigeons. Yeah, I mean, it's probably been used as an excuse for a lot of things that should have happened anyway, and it's just been perhaps a bit of pressure being taken out of the markets. But I think it's got far-reaching ramifications. It's not clear if we're going to see a currency war in Asia now and against other emerging markets. But even if that's not the intention of the Chinese, they may get that through default anyway.
Right, but I suppose at least it takes the focus off Greece and puts all of that into perspective. It's like a flea compared to the revaluation or devaluation of.
I've forgotten all about Greece now.
Yes, Greece who? Right. Okay, let's get on to data released over the European session.
Okay, so the first thing, obviously, we couldn't ignore. We've already mentioned it, but China devalued the yuan by a further 1.6%, or at least it adjusted its reference rates for the yuan against the dollar. It was the second move this week. That's 3.5% that they've effectively devalued their currency by. At the same time, we saw some industrial production numbers from China. This is for the month of July, the year-on-year change. 6%, hardly something to be upset about, until you realised that was 10% below the forecasts of 6.6% and even more below the prior read of 6.8%. So perhaps those two items are interlinked.
When you also get the feeling that the Chinese, our friends in Beijing, are aware that the data coming up in the near term may be rather soft and hence made the move in a preemptive way.
Yeah, that's quite possible. They know a lot about trying to plan an economy, don't they? They've done it for years, so maybe they're still trying to practice those dark arts. Back into Europe and to the UK, we had average earnings data this morning for the 3 months to June. Important, obviously, because the Bank of England is looking for signs of inflation as a potential catalyst to raise interest rates. I've gone here for the figure including bonuses. Came in at plus 2.4%. Well short of the forecast of plus 2.8% and indeed the prior read of plus 3.2%. What struck me as odd though here is that if you look at the figure without bonuses, it's actually a higher number. How that works, I've no idea, but that came in at 2.8%.
They're trying to copy the Chinese way of doing data, but I don't actually know what a bonus is. Maybe you can tell me what a bonus is. What is that?
It's a dim and distant memory, I think, is what
right,
that is.
Okay.
And also of importance as far as the UK economy is concerned and interest rates, the UK unemployment data for the 3 months for June, here we're looking at the outright rates of unemployment, came in at 5.6%, bang in line with the forecast of 5.6% and the prior read of 5.6%. So no better, no worse than we were the last time we had this data, but that probably isn't a cue for the Bank of England to spring into action either. It's flatlining at the moment, which is great, but it's not. In fact, it's not getting any worse, but it certainly isn't getting any better and doesn't probably force Mark Carney's hand. And then back into Europe and into the Eurozone for the industrial production numbers for June, again a year-on-year figure, and they came in at a very disappointing plus 1.2%, much lower than the forecast of plus 1.5% and the prior read of plus 1.6%. So the QE isn't working its magic here either, and so that one of the key tenets of the ECB's policy is to try and stimulate not only the export market but the domestic internal, if you will, European and Eurozone markets, and that doesn't appear to be happening, at least not with any great fervour.
Too little, too late, but nothing good on this page at all, really.
Not really, no.
Right, let's try to have a look at the next page. That's or the next slide. Is that any better?
If you're short the DAX, yes. So the DAX 30, first of our European movers, around 11,067, down 2.01%, but it had been a good deal lower than this morning. Further easing of yuan FX rates powers pressure on German exporters, which are a mainstay of the DAX 30. Having said that, if you look at the regional breakdown of where German companies get their sales, whilst Asia Pacific is a large component, it's not the biggest. So So perhaps again it's just an excuse to
or it was the hope value of what China could bring, and obviously may not do so.
Well, that's possibly the opportunity cost may have gone. He might well be right there. Anyway, it's certainly been a morning for sellers of the DAX so far. And then we move to Unilever. I've gone with the London line here. We could just as easily have looked at the Dutch line, but in London, ULVR, the ticker, £27.97. They were trading shortly before we came on air, down around 3.88%. And why? Well, I think China probably has some relevance here as well, but probably of equal, if not greater importance, is a note from Goldman, which downgrades the stock. They say sell, spread too thin. I think that's an attempt at humour, given the company's history of margarine making. They cut their price target to £25.60 from £28.20, and they highlight the threat from e-commerce to the wider sector, something they call the infinite shelf.
Really in a bad mood there, because I mean, obviously, spread too thin could be that the company is an international company with interests and products all over the place.
Well, I'm sure that's what they really mean, but I'm sure the double entendre wasn't lost on them either.
Right. Okay, and next up with the M&A?
Okay, well, it's another deal from Pearson, that's ticker PSON in London, and they've sold their 50% stake in The Economist magazine for £469 million to a combination of Exor and The Economist Group itself. It seems to me that that's a very good price they've achieved. Exor will now have a stake in The Economist, which is around about 43%. And just to remind people, Exor is the Agnelli family holding company, so the sort of founding fathers of Fiat, that family, their personal interests are managed there. This marks Pearson's exit from business publishing after the recent sale of the FT to Japan's Nikkei, and Pearson has raised around £1.27 billion from these two sales. So this leaves Pearson now as the world's largest education company, and it operates in 70 countries. It's got a market cap in dollar terms of around 14.8 billion. And that makes it significantly larger than its US peers, companies here such as Nord Anglia, ticker NORD in the States, or Apollo Education, APOL. And I just wonder now if Pearson, might use its size and the money that's freed up onto its balance sheet to perhaps consolidate its position in the US, maybe buy one or two smaller competitors to increase its foothold there.
Okay, well, intriguing stuff there on the M&A front from just one company. Onto the data points.
Quite thin, I'm afraid, as far as the data is concerned, but we do have Fed Governor Dudley speaking shortly in about 20 minutes' time. He's speaking in Rochester, New York. That'll be 1:30 in London. Again, obviously, everyone will be waiting to see what he says about interest rates, as we have done any time a Fed Governor's spoken, really, in the last month or so. And then we've got weekly crude inventories due out a little later on. Just to flag here, really, that 2 out of the last 3 reads here have been drawdowns from the crude reserves, yet crude, and I'm thinking here of WTI, has fallen by around 5.8% over the last week alone, and is down 25.1% year to date. So whatever the number is, even if it's a further drawdown, I'm not sure it's going to provide much respite for falling oil prices.
Right, okay, obviously the people looking at the bigger picture, macroeconomic picture, and obviously China is a major consumer. Right, onto the levels.
Okay, well, a couple of pre-market moves have taken my eye. The first is a company called Cree Inc. That's ticker CREE in the US, trading around $24.45 pre-market, down around 2.5%. Had an earnings miss, and there are concerns over margins at the company, which makes LEDs, lighting and RF chips. And I think also a lot of these chip manufacturing companies, they do sell quite a bit to the Far East, and within that China. So again, there must be an element of that. So as I say, they're down circa 2.5%. But going the other way, one you probably never even heard of, because I certainly hadn't until today, CDK Global. This is ticker CDK in the US, market cap of around $8.5 billion. So it's a sizable enterprise, trading around $53 pre-market, up around 9.2%, and the company is said to be exploring a PE or private equity sale. What they do for a living is provide IT and marketing solutions to automotive dealers. Can make them an attractive target for PE because it has a strong recurring cash flow, and from what I've read, there's plenty of opportunity to cut costs within the business. So I think that's one to keep on your watch list for now.
Okay, and the markets themselves, which I referred to?
Right, well, equities in Europe easier for choice, so we're now looking at 65.40 on the downside in FTSE, plays at 66.63 on the upside. For the DAX, we've slipped below 11,000 again on our downside level, so now looking at 10,960 to the downside, plays 11,162 on the upside. For the S&P, 2076 to the downside, plays 2105 to the upside. It's a wide range there in the S&P, but
not too much damage yet.
No, I suspect the bias is going to be to the downside again today, so don't necessarily expect that 2076 level to hold. And in the Dow, 17,350 plays 17,470. Just should flag in the Dow that we're below the 200-day EMA line now, and we did post what I would term to be a dead cross yesterday as well, so that's a sign of continuing or likely to continue downside momentum. In the currency market, the dollar's loss is the euro's gain, and the dollar has weakened on the China news in 2 sessions now, so we're now back to 110.84 on the downside in euro dollar, plays 111.60 on the upside. That kind of level was being flagged as a possible top for euro dollar from where it could sell off again. It'll be interesting to see if it can push through there. It wasn't far away as I left the office. Aussie dollar, US dollar, more pain for Australia here, 73.05 on the downside, plays 73.60 on the upside. Obviously, the Australian economy massively exposed to China, so any continuing weakness there will be a further negative for their currency. Again, I think in dollar yen we're seeing more dollar weakness than yen strength, but 124.20 is our downside level for the yen. Plays 124.50 on the upside. Obviously 125.00 in the background behind that upside level. And in cable, 155.60 on the downside, plays 156.05, and once again the pound benefiting from dollar weakness, although the economic data that we touched on earlier probably doesn't do cable any favours for the moment either.
Right, so but sort of people again, once again looking at the bigger picture rather than specific data or
absolutely, yeah. The macro picture is everything again for the moment.
Okay, well that's it for the Wall Street Crossover Show. Thank you to Darren Sinden, market commentator for Admiral Markets, and we'll be back at 1 p.m. tomorrow.